The global economy has been very resilient over the past couple of years. We've had several very large shocks and growth has continued. That's going to be challenged this year, and particularly it's going to be challenged by President Trump's trade war. So far, though, it's been very interesting in that the global economy has been relatively resilient. There's been a lot of distortion in the data. In particular, US imports surged ahead of the tariffs and have now come back. But in underlying terms, so far, it's actually held in better than some had feared. Part of the Trump agenda is to reduce the US's reliance on China. But that's really interesting in itself, in that you've had very large swings in the trade relationship between those countries over the past few decades. In the 1980s, only about 8% of Chinese exports went to the US. That went up to nearly 25%. Interestingly, the proportion peaked just before China joined the WTO. It's been falling ever since. But the perversity now is that as of today, the share of China's exports to go to the US is the same as it was in the 1980s. But China's exports in total have not fallen because we've had a redirection of trade. That's exactly what happened during Trump 1.0 when we had Trade War 1.0. I suspect that will continue, and it probably means that the impact on the global economy is less than some people are thinking it might be. So the tariffs obviously have had a big impact on global markets, and in particular US markets. In terms of the bond market and the FX market, what's been interesting is that normally when you have a shock to the global system, people have what they buy safe havens, and that is often involves buying US bonds, which pushes up the US dollar. This time, because the US is the center of the shock, and in particular the uncertainty in terms of the US policy stance, that hasn't happened. In fact, the dollar's fallen and US bond yields have gone up. Australia will be affected. We are part of the global economy, but we are, I think, in a better place than almost any other country. The share of our exports that go to the US is very small. Inflation is back inside the RBA's band, so the RBA can cut interest rates when and if needed. And we have a lot of fiscal space, which means that if needed, the government can actually stimulate. So it doesn't mean we're not affected, but we're in a very good place compared to most other countries. So the RBA has been easing this year. What happens next is very much dependent on what happens with the economy. Given that inflation has come back to they want it to be, the economy is soggy and we've got global headwinds, I think they'll cut a little bit more, but I don't think they'll cut very much. To get a really large cut from here, you would need something bad to happen in the global economy. So Europe, again, is interesting in that this is very unfortunate timing, in that Europe was finally recovering after the very difficult couple of years, the energy shock in 2022, increased interest rates, and then the tariff shock has come. Initially, it's been interesting in that European exports to the United States surged. So GDP growth in the first quarter was actually stronger because of the tariffs. But of course, now there'll be some payback. So again, I think it's resilient. I think it'll hold in there. But I think we are going to have a period of very weak growth and probably stagnation over the rest of the year.